Now let's take that idea one step further. If I were sitting across the table from someone who was 55, 60, or even 65 years old and they told me, I want my portfolio to generate meaningful income, but I don't want to completely give up growth, I wouldn't start by showing them a list of the highest yielding ETFs. I'd start with a much simpler question. What do you want this portfolio to accomplish? Because your portfolio should reflect your life. If you're still working and don't need the income today, you may be able to tolerate more volatility in exchange for greater long-term growth. But if you're already retired and using portfolio distributions to pay your monthly bills, the equation changes. A 30% decline isn't just a number on a chart anymore. It can affect your confidence. It can affect your spending. And if you're forced to sell investments while they're down, that temporary decline can become a permanent loss. This is why I think the concept of a core position is so important. A core position is not necessarily the investment with the highest yield. It's the investment you are willing to build your financial structure around. And if I were constructing an American income portfolio based on the ideas we've discussed, the NASDAQ 100 would probably occupy that role. The reason isn't simply that technology has performed well in the past. It's because of the economic structure behind many of these companies. Think about the world we live in. Artificial intelligence requires computing power. Computing power requires semiconductors. Businesses need cloud infrastructure. Consumers use digital platforms. Companies spend billions on software. Advertising has moved online. And increasingly, financial activity itself is becoming digital. Many of the companies sitting inside the NASDAQ 100 are directly connected to these structural changes. That doesn't mean they will always go up. Nothing in the stock market works that way. There will be recessions. There will be valuation bubbles. There will be periods when investors suddenly decide that technology stocks are too expensive. And there will be years when something completely unexpected happens. But when you're building a portfolio for decades, you don't necessarily need to predict every economic event. Sometimes you simply need exposure to businesses that have a reasonable chance of remaining important as the economy evolves. That's where an income-oriented NASDAQ strategy becomes interesting. Instead of saying, I only want growth, you're essentially saying, I want exposure to growth, but I'd also like the portfolio to produce cash flow. This is where covered calls enter the picture. Let's make the concept extremely simple. Suppose you own shares of a company or an index. You can sell someone else an option that gives them the right to buy those shares from you at a certain price. They pay you a premium for that right. If the option expires without being exercised, you keep the premium. That's the basic engine behind covered call income. And when a fund does this repeatedly across a large portfolio, those premiums can become a recurring source of distributions. It sounds attractive, and sometimes it is. But here's the part investors need to understand. Covered calls are not magic. They don't manufacture money. The premium you receive is compensation for taking on a specific trade-off. If the market suddenly explodes higher, your upside may be limited because the calls you sold can become valuable to the buyer. In other words, you are exchanging some potential upside for current income, and that trade-off can actually make sense for certain investors. Imagine you're retired. You don't necessarily need every last dollar of potential upside. You might prefer receiving cash today rather than waiting for an uncertain gain tomorrow. But if you're 30 years old and still have decades before retirement, giving up too much upside could potentially be a bigger concern. Same strategy, different investor, different answer. That's why I don't believe there is a universally best ETF. There is only an ETF that may or may not fit your objective. Now, there is another ingredient that makes some of these funds much more aggressive: leverage. And this is where I would ask you to pay very close attention. Leverage can make a good environment look spectacular. If the underlying market rises, leverage can amplify the result. But if the market falls, leverage doesn't suddenly disappear. The losses can become larger too. Think of leverage as turning up the volume. If the music sounds good, you hear more of it. But if the music becomes unpleasant, you're also hearing more of that. That's why a leveraged ETF should never be evaluated simply by looking at its advertised distribution rate. You have to ask how the fund generates that distribution. What happens to the underlying NAV? How volatile the strategy is? And what could happen during a prolonged bear market? This is especially important with products that combine leverage and options strategies. You are stacking multiple mechanisms together, and complexity can be useful, but complexity can also hide risk. That's why I would rather have a portfolio where I understand the role of every major position than own 10 different ETFs simply because each one promises an attractive yield. Now let's talk about the second major component, Bitcoin. Whether you love Bitcoin or dislike it, it's difficult to deny that it has become part of the broader investment conversation. But I would not treat Bitcoin exposure the same way I treat a NASDAQ 100 core position. They're fundamentally different. The NASDAQ 100 represents a broad group of large companies. Bitcoin is a completely different asset class. And companies such as MicroStrategy, now known as Strategy, introduce another layer of complexity because you're not simply owning Bitcoin. You're owning a company whose financial strategy is heavily connected to Bitcoin. That means the risk can be substantially different. This is why, in a portfolio like the one we're discussing, I would consider Bitcoin and MSTR-related exposure to be satellite positions. They can potentially add significant upside, but they should not automatically become the foundation of a retirement portfolio. You don't build the foundation of your house out of the most volatile material you can find. You use the strongest materials for the foundation. Then you can become more creative with the rest of the structure. And that's how I think about portfolio construction. The core should carry most of the weight. The satellites should provide opportunity. This brings us to another interesting group, crypto and technology income ETFs. Funds such as SEPY and BLOX are interesting because they sit somewhere between traditional technology investing and the emerging digital asset economy. They can contain companies connected to Bitcoin, cryptocurrency, semiconductors, financial technology, and other areas of the technology ecosystem. And because these strategies are designed to generate income, they can potentially complement a larger NASDAQ position. But again, I would be careful with the word complement. A portfolio can look diversified on paper while being heavily concentrated underneath. If your NASDAQ ETF owns NVIDIA, Microsoft, Amazon, Meta, and other technology giants, and then your crypto ETF also owns technology companies, you're not necessarily reducing your technology exposure. You may actually be increasing it. This is one of the most common mistakes I see investors make. They count ETFs instead of counting exposures. They say, I own 8 different ETFs, so I'm diversified. But if 6 of those ETFs ultimately depend on the same group of technology companies, you may have 8 wrappers around the same underlying risk. That's why I always encourage investors to look through the ETF. Don't just ask what the fund is called. Ask what you actually own. And then there is gold. Gold has a very different purpose. I don't necessarily look at gold as the engine of portfolio growth. I look at it more as a form of diversification. Gold doesn't need to outperform the NASDAQ 100 every year to have value. Its role can simply be different. When investors become nervous about inflation, geopolitical uncertainty, financial instability, or other forms of systemic risk, gold can sometimes behave differently from stocks. That doesn't mean gold always goes up when stocks go down. It doesn't. But diversification isn't about finding assets that always move in opposite directions. It's about avoiding a portfolio where everything depends on the exact same economic outcome. The same logic applies to energy infrastructure. Pipeline and MLP-related investments can provide exposure to the physical infrastructure that transports energy across the economy. These businesses are not identical to technology companies. Their economics are different. Their cash flow characteristics can be different, and that can make them useful as a smaller component of an income-oriented portfolio. But again, I wouldn't make them the centerpiece. The goal isn't to create 20 different sources of complexity. The goal is to create a few different sources of return. That distinction matters, because when you look at the entire portfolio together, the picture becomes much clearer. You might have a large NASDAQ-oriented core designed to combine growth and income. You might have a smaller Bitcoin or MSTR position designed for higher risk growth. You might add crypto and technology income strategies. You might keep a small allocation to gold. And you might add energy infrastructure for another source of income and diversification. Suddenly, every investment has a job. And when every investment has a job, it becomes much easier to understand what you're doing. But there is one more principle I want to emphasize. Don't fall in love with the distribution number. I've seen investors become emotionally attached to a fund because it pays them every week. The payments feel good. They arrive in the account. They create the psychological feeling that the investment is working. But your brokerage account doesn't care how often you get paid. Your real wealth is determined by the combination of the cash you receive and the value of what remains invested. That's why total return matters. Imagine two portfolios. Portfolio A produces a 20% distribution but loses 15% of its value. Portfolio B produces a 10% distribution and grows 12% in value. You cannot simply say Portfolio A is better because 20% is larger than 10%. You have to examine the entire economic result. This is one of the most important lessons in income investing. Income is only one part of the equation. Growth is another. Capital preservation is another. Risk is another. Taxes are another. And your personal spending needs are another. The best portfolio is the one that balances these variables in a way that allows you to stay invested. Because ultimately, the most dangerous portfolio isn't necessarily the one with the highest risk. Sometimes the most dangerous portfolio is the one that makes you panic at exactly the wrong moment. If you build a portfolio that looks fantastic on paper, but you cannot emotionally tolerate a 30% or 40% decline, then the strategy may not actually be suitable for you. The market will eventually test your conviction. It always does. And when that moment comes, the question won't be whether your ETF had the highest yield. The question will be whether you understood what you owned well enough to stay disciplined. That's what separates an investment strategy from an investment collection. A collection asks, what should I buy? A strategy asks, why am I buying it? What role does it play? And what am I willing to accept in return?